Hello, friends. Welcome back to Book Demystified once again. And today, we're going to discuss about the book, The Warren Buffett Way by Robert G. Hagstrom. Now, I know what you're thinking. Another book about some rich guy telling us how to invest, right? But hold on, because what we're diving into today isn't just another get-rich-quick scheme or some Wall Street jargon that'll make your head spin. We're talking about the man who turned a failing textile company into a multi-billion-dollar empire, who bought his first stock at age 11, and who's been consistently beating the market for over 6 decades. Warren Buffett didn't inherit his wealth, didn't get lucky with some tech startup, and definitely didn't win the lottery. Instead, he developed a set of principles that are so simple, yet so powerful, that they've made him one of the richest people on earth. But here's the kicker, and this is why I'm so excited to share this with you today. These principles aren't some secret formula locked away in a vault. They're not complicated mathematical equations that require a PhD from Harvard. They're actually surprisingly straightforward concepts that any of us can understand and apply, whether you're a college student with $50 to invest or someone approaching retirement with a 401k that's been gathering dust. The problem is, most of us have been conditioned to think that successful investing requires constant trading, following hot tips, or trying to time the market. We see these day traders on social media flashing their gains, and we think that's what investing looks like. But what if I told you that the world's most successful investor rarely trades, ignores most stock tips, and has held some of his investments for decades? You see, while everyone else is playing the short-term game, getting stressed about daily market fluctuations and checking their portfolios every 5 minutes like it's Instagram, Buffett has been playing an entirely different game. And the results speak for themselves. Since 1965, Berkshire Hathaway's stock price has grown at an annual rate of about 20% compared to the S&P 500's 10%. That might not sound like a huge difference, but let me put this in perspective for you. If you had invested $10,000 with Buffett in 1965, by 2020, that investment would be worth over $270 million. With the S&P 500, that same $10,000 would be worth about $1.7 million. Still great, but we're talking about a difference of over $260 million. Now, I'm not sharing this to make you feel bad about your current financial situation or to suggest that you should have been born 50 years earlier. I'm sharing this because the principles that created this incredible wealth are available to all of us right now, today in 2025. And throughout this video, we're going to break down exactly what those principles are, how they work in practice, and most importantly, how you can start applying them to your own financial journey, regardless of where you're starting from. But before we dive deep into Buffett's world, let me ask you something personal. How many times have you checked your investment accounts this week? How many times have you bought a stock because someone on Reddit said it was going to the moon? Or sold something because the news made it sound like the world was ending? If you're like most Americans, including myself for many years, the answer is probably more times than you'd like to admit. We live in a culture of instant gratification, where we expect results yesterday, and we apply that same mindset to investing. But what if the secret to building real, lasting wealth is actually the complete opposite of what we've been taught? This is where Buffett's story becomes so fascinating, and why understanding his approach could literally change your financial future. When Buffett was growing up in Omaha, Nebraska during the 1930s and 1940s, he wasn't surrounded by the constant noise of financial media, social media stock tips, or the pressure to make quick trades. Instead, he developed his investment philosophy through careful study, patience, and a deep understanding of business fundamentals. He learned to see stocks not as pieces of paper that go up and down, but as ownership stakes in real businesses with real products, real customers, and real profits. Imagine if instead of checking your Robinhood app every morning with anxiety about whether your stocks went up or down, you woke up thinking about whether the businesses you own are serving their customers better today than they did yesterday. Imagine if instead of worrying about what the Federal Reserve might do next week, you focused on whether the companies you've invested in have strong enough competitive advantages to thrive regardless of economic conditions. This shift in thinking, from trader to business owner, is the foundation of everything we're going to discuss today. And here's something that might surprise you. Buffett's greatest returns didn't come from complicated financial instruments or insider information. They came from understanding simple businesses that were trading at reasonable prices and then having the patience to let those businesses compound their value over time. We're talking about companies like Coca-Cola, which he started buying in the late 1980s and still holds today. We're talking about See's Candies, which Berkshire bought in 1972 for $25 million and which has since generated over $2 billion in profits. These aren't mysterious, complex businesses. They're companies that make products people want to buy, that have strong brand recognition, and that generate consistent profits year after year. But Buffett's success isn't just about picking good companies. It's about understanding the psychology of markets, the importance of price relative to value, and perhaps most critically, the power of compounding over long periods of time. Albert Einstein allegedly called compound interest the eighth wonder of the world, and Buffett has proven this theory better than perhaps anyone in history. While others are focused on making 10 or 20% this year, Buffett thinks about making 20% annually for the next 20 years. And the mathematical difference between these approaches is absolutely staggering. Let me give you a real-world example that hits close to home for many Americans. Think about student loans for a moment. We all know how compound interest works against us when we're paying 18% on credit card debt or 6% on student loans. Every month we don't pay those balances down, we're not just paying interest on the original amount, but interest on the interest. It's painful, and it's why so many people feel trapped in debt cycles. But Buffett figured out how to make compound interest work for him instead of against him. Every dollar of profit that Coca-Cola generates gets reinvested back into the business, generating more profits, which get reinvested again, creating this beautiful snowball effect that has made his Coca-Cola investment worth billions today.
Now, I know what some of you are thinking. That's great for Warren Buffett, but he had advantages I don't have. He had connections, he had capital, he had opportunities that regular people don't get. And while it's true that Buffett eventually gained access to investment opportunities not available to individual investors, his foundational principles and his most successful investments were based on publicly available information and common-sense business analysis that anyone could have done. The real advantage Buffett had wasn't money or connections. It was patience, discipline, and a willingness to go against the crowd when everyone else was panicking. Think about March 2020, when the COVID pandemic first hit and the stock market crashed. While most people were selling everything in a panic, wondering if this was the end of capitalism as we know it, Buffett was relatively quiet. He didn't panic, he didn't sell his core holdings, and when opportunities presented themselves, he was ready to act. This wasn't because he had some crystal ball that told him the market would recover. It was because he understood that good businesses with strong competitive advantages and competent management would find ways to adapt and eventually thrive, regardless of short-term disruptions. This brings us to one of the most important concepts we're going to explore today, the idea of thinking like a business owner rather than a stock trader. When you own shares of Apple, you don't just own a ticker symbol that moves up and down based on market sentiment. You own a tiny piece of one of the most profitable companies in human history. You own a piece of a company that generates over $300 billion in annual revenue, that has created an ecosystem of products and services that billions of people depend on daily, and that sits on a cash pile larger than the GDP of most countries. But here's where most investors get it wrong. They buy Apple stock and then spend their days worrying about whether it's going to go up or down this week based on what some analyst on CNBC said, or whether the latest iPhone sales numbers beat expectations by 2% or missed them by 1%. Buffett, on the other hand, bought Apple because he understood that the company had built something incredibly rare, a brand so strong and an ecosystem so integrated that customers would continue choosing Apple products for years to come, regardless of minor fluctuations in quarterly results. This is what Hagstrom calls the business perspective in his book, and it's absolutely crucial to understand if you want to invest like Buffett. When you develop this perspective, market volatility stops being something that keeps you awake at night and starts being something that occasionally presents opportunities. When Apple stock drops 20% because investors are worried about iPhone sales in China, a business owner sees this as potentially getting to buy a great company at a discount, not as a reason to panic about their investment. And this leads us into another crucial principle that sets Buffett apart from almost every other investor: his concept of intrinsic value versus market price. This might sound complicated, but it's actually pretty straightforward when you break it down. Intrinsic value is what a business is actually worth based on its ability to generate cash over time. Market price is what investors are willing to pay for the stock at any given moment. Sometimes these two numbers are close to each other, sometimes the market price is way higher than intrinsic value, and sometimes, and this is when Buffett gets excited, the market price is significantly lower than what the business is actually worth. Let me give you an analogy that might help this click. Imagine you're at a garage sale, and you see a guitar sitting in the corner with a price tag of $50. Now, if you don't know anything about guitars, $50 might seem reasonable or expensive depending on how it looks. But if you happen to be a guitar expert and you recognize that this is actually a vintage Martin guitar that's worth $5,000, suddenly that $50 price tag looks like an incredible opportunity. The guitar's intrinsic value hasn't changed. It's still worth $5,000, but the seller, who doesn't understand what they have, is willing to sell it for $50. This is essentially what Buffett does in the stock market, except instead of looking for underpriced guitars, he's looking for underpriced businesses. And just like the guitar example, this requires knowledge and patience. You need to understand how to evaluate what a business is actually worth, and you need to be patient enough to wait for the market to offer you prices that are significantly below that intrinsic value. Now, calculating intrinsic value isn't as simple as looking up a number somewhere. It requires understanding the business, analyzing its financial statements, evaluating its competitive position, and making reasonable assumptions about its future cash flows. But Buffett has simplified this process by focusing on businesses that are easy to understand and predict. He calls this his circle of competence, and it's another principle that can dramatically improve your investment results. Your circle of competence is basically the industries and types of businesses that you understand well enough to make informed judgments about their future prospects. For Buffett, this has traditionally included consumer goods companies like Coca-Cola and Gillette, insurance companies like GEICO, and more recently, technology companies like Apple and Microsoft. Notice that these are all businesses with relatively simple, understandable business models. Coca-Cola makes beverages that people love to drink. Gillette makes razors that people need to shave. Apple makes phones and computers that people want to buy. What you won't find in Buffett's portfolio are biotech companies developing experimental cancer drugs or tech startups with no revenue but big dreams about changing the world. It's not that these companies can't be successful or profitable, some of them certainly will be. It's that they're outside of Buffett's circle of competence, and he's learned that trying to evaluate businesses you don't understand is a recipe for poor investment decisions. This is incredibly liberating when you think about it, especially in today's investment environment where we're constantly bombarded with information about hundreds of different investment opportunities. Social media is full of people promoting everything from cryptocurrency to penny stocks to complex derivative strategies. The financial media covers dozens of new IPOs every month, each promising to be the next Amazon or Tesla. But Buffett's approach suggests that you don't need to understand or invest in all of these opportunities. You just need to find a few businesses within your circle of competence that you can buy at attractive prices and hold for the long term.
And this brings us to another crucial aspect of Buffett's success, his incredible patience and long-term thinking. In a culture where we're used to getting everything instantly, where we can order food and have it delivered in 30 minutes, where we can stream any movie ever made with the click of a button, the idea of holding an investment for 10 or 20 years seems almost absurd. But this long-term perspective is actually one of Buffett's greatest competitive advantages. Think about it this way. If you're planning to hold a stock for just a few months or even a few years, you're competing against millions of other investors who are all trying to predict short-term price movements. You're competing against professional traders with faster computers, better information, and more experience than you have. But if you're willing to hold great businesses for decades, you're suddenly competing in a much less crowded space. Most investors simply don't have the patience or the long-term perspective to play this game. And the results of this long-term thinking are extraordinary. Buffett's Coca-Cola investment, which he made starting in 1988, is now worth about $25 billion on an initial investment of around $1.3 billion. His investment in See's Candies has returned over 80 times its original cost through a combination of dividends and increased business value. These aren't the kinds of returns you get by trading in and out of stocks based on short-term news or market sentiment. These are the returns you get by finding great businesses and giving them time to compound their value. But let's get practical for a moment, because I know some of you are thinking, this all sounds great in theory, but how do I actually apply these principles with my own investments? The good news is that you don't need millions of dollars or access to private deals to start investing like Buffett. You can begin applying these principles today with whatever amount you have available to invest. Hey, if you're enjoying our free book summaries and want to support what we do, there are a few easy ways to help. You can subscribe to the channel, become a member, or grab the book using our affiliate link in the description. And if you'd like to go a step further, you can also leave a tip via PayPal or UPI, the link's below. Every bit of support helps us keep creating valuable content for you. Now, let's dive deeper into how you can actually start implementing Buffett's approach. The first step is developing what Hagstrom calls the mental models that guide Buffett's thinking. These are essentially frameworks for analyzing businesses and making investment decisions, and they're surprisingly practical once you understand them. The first mental model is what Buffett calls economic moats. Just like medieval castles were protected by water-filled moats that made them difficult to attack, great businesses are protected by competitive advantages that make it difficult for competitors to challenge. These moats can take several different forms, and understanding them is crucial to identifying businesses worth owning for the long term. Some companies have cost advantages that allow them to offer products or services at lower prices than their competitors while still maintaining healthy profits. Walmart is a classic example of this type of moat. Through massive scale and incredible efficiency in their supply chain and operations, Walmart can offer products at prices that smaller retailers simply can't match. Even if a competitor wanted to challenge Walmart, they would need to invest billions of dollars in many years to build a comparable distribution network and achieve similar scale efficiencies. Other companies have what are called network effects, where their products or services become more valuable as more people use them. Think about Facebook or Instagram. These platforms become more useful and engaging as more of your friends and family join them. A competitor trying to launch a new social media platform doesn't just need to build better technology. They need to somehow convince millions of people to leave their existing networks and start over somewhere else, which is incredibly difficult to do. Brand loyalty represents another type of economic moat, and this is where companies like Coca-Cola really shine. Despite the fact that Pepsi often wins in blind taste tests, and despite the fact that there are hundreds of other cola options available, Coca-Cola maintains dominant market share in most countries around the world. This isn't because Coke tastes better than every alternative. It's because the Coca-Cola brand represents something more than just a beverage to many consumers. It represents happiness, celebration, tradition, and countless positive memories. That emotional connection creates customer loyalty that's incredibly difficult for competitors to replicate, no matter how much money they spend on advertising or product development. Regulatory moats represent another form of competitive advantage, though they can be trickier to evaluate because regulations can change over time. Utility companies often have regulatory moats because governments typically grant them exclusive rights to serve specific geographic areas. It wouldn't make economic sense to have 5 different companies building separate electrical grids to serve the same neighborhood, so regulators usually grant monopoly rights to one company in exchange for accepting government oversight of their pricing and service quality. The key to identifying strong economic moats is thinking about what would happen if a well-funded competitor decided to challenge the business you're considering. If a company with unlimited resources could easily replicate what your target business does and take away significant market share, then that business probably doesn't have a strong moat. But if there are significant barriers that would make such a challenge difficult, expensive, or time-consuming, then you might be looking at a business with durable competitive advantages. Let me give you a practical example of how this analysis might work. Suppose you're considering investing in Netflix. You might ask yourself, what would it take for a competitor to challenge Netflix's position in the streaming market?
Well, they would need to spend billions of dollars licensing content from studios and production companies. They would need to develop their own original programming, which requires not just money, but also relationships with writers, directors, and actors. They would need to build a technology platform that can deliver high-quality video to millions of users simultaneously. And they would need to convince consumers to pay for yet another streaming subscription in an already crowded market.
As it turns out, several well-funded companies have tried to do exactly this. Disney launched Disney+. Apple launched Apple TV+. Amazon has Prime Video, and HBO has HBO Max. Some of these have been more successful than others, but none have been able to simply replicate Netflix's success overnight. This suggests that Netflix has some meaningful competitive advantages, though you'd want to dig deeper to understand how sustainable those advantages are in the long term. The second mental model that's crucial to understand is Buffett's approach to management evaluation. Buffett has often said that he'd rather own a wonderful business run by competent managers than a mediocre business run by brilliant managers. But the quality of management still matters enormously. After all, managers are the people who decide how to allocate the company's capital, which markets to enter or exit, and how to respond to competitive challenges. Buffett looks for managers who think like owners rather than employees. This means they're focused on building long-term value rather than hitting short-term targets that might boost their bonuses but hurt the business over time. It means they're careful about how they spend shareholders' money, treating it as if it were their own. And it means they're honest and transparent in their communications with shareholders, acknowledging problems and mistakes rather than trying to spin everything in a positive light. One way to evaluate management quality is by looking at how they've allocated capital over time. Have they made smart acquisitions that have added value to the business? Or have they overpaid for companies that ended up being disappointments? Have they invested in research and development, equipment, and other initiatives that have strengthened the business's competitive position? Have they returned excess cash to shareholders through dividends or share buybacks when they couldn't find attractive investment opportunities within the business? You can also learn a lot about management by reading their annual letters to shareholders and listening to their quarterly earnings calls. Do they speak honestly about both the opportunities and challenges facing their business? Do they take responsibility for poor results, or do they always blame external factors? Do they make realistic projections about future performance, or do they consistently overpromise and underdeliver? Jeff Bezos, the founder of Amazon, is someone Buffett has praised for his long-term thinking and customer focus, even though Buffett was initially skeptical about investing in Amazon because it was outside his circle of competence. Bezos consistently demonstrated that he was willing to sacrifice short-term profits to build long-term competitive advantages. Amazon's willingness to operate at thin margins or even losses for years while building their logistics network, developing new products and services, and expanding into new markets showed that management was thinking like owners rather than focusing solely on quarterly earnings reports. The third mental model is understanding the economics of the businesses you invest in. This doesn't mean you need to become an accountant or financial analyst, but you do need to understand some basic concepts about how businesses generate profits and cash flows. Buffett focuses particularly on businesses that can grow their earnings without requiring proportional increases in capital investment. Let me explain this with a simple example. Imagine you own a pizza restaurant that generates $100,000 in annual profit. If you want to double your profits to $200,000, you might need to open a second location, which could require an investment of several $100,000 for equipment, furniture, initial inventory, and working capital. Even if the investment is successful, it might take several years before the second location generates enough profit to provide an attractive return on your investment. Now compare this to a business like Microsoft's Office software suite. Once Microsoft has developed a new version of Office, they can sell millions of copies with relatively little additional investment. The marginal cost of producing and distributing each additional copy is essentially zero, especially for digital downloads. This means that as Microsoft's customer base grows, most of the additional revenue flows directly to their bottom line as profit. Businesses with these kinds of economics can compound their value much more rapidly than businesses that require significant capital investment for each unit of growth. This is why Buffett has historically been attracted to businesses like insurance companies, which collect premiums up front and invest the money before paying out claims, and consumer brands like Coca-Cola, which can expand into new markets without building expensive manufacturing facilities. But it's not just about the current economics of the business. You also need to think about how those economics might change over time. Industries that are being disrupted by technology, changing consumer preferences, or regulatory changes might see their attractive economics deteriorate, even if they look great today. The newspaper industry is a classic example of this. Newspapers used to be incredible businesses with strong local monopolies and attractive economics. But the internet fundamentally changed how people consume news and how advertisers reach customers. This is where Buffett's emphasis on predictability becomes so important. He prefers businesses whose fundamental economics are likely to remain attractive for many years into the future. Coca-Cola's business model probably won't look dramatically different 20 years from now. They'll still be making beverages that people enjoy drinking, and they'll still have strong brand recognition and global distribution capabilities. The same can't necessarily be said for companies in rapidly evolving industries like artificial intelligence or biotechnology. The fourth mental model is understanding market psychology and using it to your advantage. Buffett has famously said that you should be fearful when others are greedy and greedy when others are fearful. This isn't just a clever quote, it's a practical approach to taking advantage of the emotional extremes that periodically affect stock prices. Markets are driven by human emotions just as much as they're driven by business fundamentals. When people are optimistic about the future, they tend to bid stock prices up to levels that may not be justified by the underlying business performance. When people are pessimistic, they tend to sell stocks at prices that may be well below what the businesses are actually worth. These emotional swings create opportunities for patient investors who can maintain their objectivity during both good times and bad.
Think about the dot-com bubble of the late 1990s. Investors were so excited about internet companies that they were willing to pay astronomical prices for businesses that had never generated a profit and might never do so. Companies with no revenue were valued at billions of dollars, based purely on speculation about what the internet might make possible. Buffett was widely criticized during this period for being behind the times because he refused to buy these high-flying technology stocks. Many investors thought he had lost his touch and that the old rules of investing no longer applied. Of course, we know how this story ended. When the bubble burst in 2000, many of these companies lost 90% or more of their value, and some went out of business entirely. Meanwhile, Berkshire Hathaway's focus on profitable businesses with strong competitive advantages allowed it to weather the storm much better than the overall market. The same pattern repeated during the financial crisis of 2008-2009. When Lehman Brothers collapsed and it looked like the entire financial system might fail, investors panicked and sold almost everything. High-quality companies with strong balance sheets and profitable business models saw their stock prices fall alongside much weaker companies that were genuinely at risk of bankruptcy. This created extraordinary opportunities for investors who could maintain their composure and think rationally about business values rather than getting caught up in the general panic. Buffett took advantage of this crisis by making several large investments in companies like Goldman Sachs, General Electric, and Bank of America. These weren't speculative bets on a market recovery. They were investments in fundamentally sound businesses that were trading at prices that didn't reflect their long-term earning power. In each case, Buffett was able to negotiate favorable terms because these companies needed capital, and he was one of the few investors willing to provide it during such uncertain times. But you don't need to wait for major market crises to apply this principle. Individual stocks regularly experience significant price swings based on short-term news that doesn't fundamentally change the long-term prospects of the underlying business. A pharmaceutical company might see its stock price drop 20 or 30% because a new drug failed in clinical trials, even though the company has a dozen other promising drugs in development and a portfolio of existing products that generate billions in annual revenue. A retailer might see its stock price fall because same-store sales growth was slightly below expectations, even though the company is still growing profits and gaining market share. These kinds of temporary price dislocations create opportunities for investors who can distinguish between short-term noise and long-term business fundamentals. The key is having a clear idea of what you think a business is worth based on its long-term earning power, and then being patient enough to wait for the market to offer you shares at a significant discount to that intrinsic value. Now, let's talk about how you can actually start applying these principles in your own investment portfolio. One of the most practical pieces of advice from Hagstrom's book is that you don't need to find dozens of great investment opportunities. Buffett's portfolio has historically been quite concentrated, with his largest positions often representing 10, 15, or even 20% of Berkshire Hathaway's total value. This concentration allows him to focus his research efforts on his best ideas, rather than spreading his attention across hundreds of different investments. For individual investors, this might mean building a portfolio of 15 to 25 individual stocks rather than trying to own a little bit of everything. This approach requires more work than simply buying index funds, but it also gives you the potential to generate superior returns if you can identify businesses trading below their intrinsic values. The process starts with identifying businesses within your circle of competence. What industries do you understand well because of your work experience, personal interests, or daily life? If you work in healthcare, you might have insights into which pharmaceutical companies are developing promising treatments, or which medical device companies are gaining market share. If you're passionate about cars, you might understand which automakers are best positioned to succeed in the transition to electric vehicles. If you're a heavy user of consumer technology, you might have opinions about which companies are building products that customers truly love versus companies that are struggling to differentiate themselves. Once you've identified some potential investment candidates, the next step is evaluating their competitive positions and long-term prospects. This doesn't require a finance degree, but it does require careful thinking about the business fundamentals we've discussed. Does the company have meaningful competitive advantages that will allow it to maintain or grow its market share over time? Is management focused on building long-term value, or are they primarily concerned with hitting short-term targets? Are the company's current profit margins sustainable, or are they likely to face pressure from competition, regulation, or changing consumer preferences? You'll also want to develop at least a rough sense of what you think the business is worth based on its long-term earning power. This doesn't require complex financial models, but you should have some idea of whether the current stock price represents good value, fair value, or expensive value relative to the company's long-term earning power. One simple approach is to look at the company's current earnings and think about what kind of growth rate seems reasonable over the next 5 to 10 years. If a company is currently earning $2 per share, and you think those earnings might grow at 8% annually over the next decade, then the company should earn about $4.30 per share in 10 years. If you're willing to pay 15 times earnings for that future cash flow, then you'd be willing to pay $65 per share today. This is obviously a simplified example, and real valuation analysis involves considering many other factors like debt levels, dividend payments, potential changes in profit margins, and the reliability of those earning projections. But the basic principle is that you want to have some sense of what you're getting for your money when you buy shares of a business.
Perhaps most importantly, you need to develop the psychological discipline to stick with your long-term approach, even when it feels uncomfortable. There will be times when your stocks are underperforming the overall market, and you'll be tempted to sell them and buy whatever's currently popular. There will be times when negative news about your companies makes you question your investment decisions. There will be times when your friends are making money trading cryptocurrency or meme stocks, while your boring, profitable businesses seem to go nowhere. This is where understanding the power of compounding becomes so important. Small differences in annual returns become enormous differences in long-term wealth because of the mathematical magic of compound growth. An investment that grows at 12% annually will double every 6 years, while an investment that grows at 8% annually will double every 9 years. Over a 20 or 30-year period, this difference compounds into dramatically different outcomes. But achieving these superior long-term returns requires accepting short-term volatility and periods of underperformance. Even Buffett has had years where Berkshire Hathaway significantly underperformed the overall stock market. The key is maintaining confidence in your investment approach and the businesses you own, as long as the fundamental reasons for owning them remain intact. Let me share a personal story that illustrates this point. Several years ago, I invested in a consumer goods company that I believed had strong competitive advantages and excellent long-term prospects. For the first 18 months, the stock went absolutely nowhere while the overall market continued climbing. I started to question whether I had made a mistake, especially when friends were bragging about their gains in technology stocks that seemed to go up every day. But I reminded myself of the reasons I had bought the stock in the first place. The company continued growing its market share, its profit margins remained healthy, and management was making smart investments in new products and international expansion. The stock price hadn't moved, but the underlying business was getting stronger every quarter. Eventually, other investors began to recognize this value, and the stock price started to reflect the improved business performance. Over a 3-year period, the investment generated returns well above the overall market, but only because I was patient enough to wait for the market to recognize what I believed was already true about the business. This experience taught me one of the most important lessons about investing. The stock market is not always an efficient pricing mechanism in the short term, but it tends to be quite accurate over longer periods. Businesses that consistently grow their profits and strengthen their competitive positions will eventually see their stock prices reflect that success, even if the timing is unpredictable. As we wrap up our exploration of Warren Buffett's principles, I want to address something that might be weighing on your mind. You might be thinking that this all sounds great in theory, but that the opportunities Buffett found in his early career simply don't exist anymore. After all, markets are more efficient today with millions of professional analysts and sophisticated computer algorithms constantly searching for undervalued stocks. Information travels instantly, and it seems like any good investment opportunity would be discovered and bid up to fair value almost immediately. There's some truth to this concern. Finding dramatically undervalued stocks is probably more difficult today than it was in the 1950s and 1960s when Buffett was getting started. But I would argue that the core principles we've discussed remain as relevant today as they ever were, and that patient investors who focus on business fundamentals can still achieve superior long-term returns. First, remember that most market participants are still focused on short-term results rather than long-term value creation. Mutual fund managers are evaluated based on their quarterly performance relative to benchmark indices. Day traders are looking for stocks that might move 5 or 10% over the next few days or weeks. Even many individual investors check their portfolios daily and make decisions based on recent news rather than long-term business prospects. This short-term focus creates opportunities for investors who are willing to think differently. When a great business reports quarterly earnings that are 2 cents below analysts' expectations, the stock might fall 10%, even though nothing fundamental has changed about the company's long-term prospects. When investors become concerned about a recession that might or might not happen, they might sell shares of businesses that would actually benefit from an economic downturn. When new regulations create uncertainty in an industry, investors might avoid the entire sector, even though some companies within that industry are well positioned to adapt and thrive. Second, the principles of identifying businesses with strong competitive advantages, competent management, and attractive economics remain as important today as they were 50 years ago. The specific industries and companies that meet these criteria have certainly changed. Buffett's early investments in textile companies and department stores wouldn't make sense today, but the underlying framework for evaluation remains sound. Technology has actually created new types of economic moats that didn't exist in Buffett's early career. Network effects, data advantages, and platform economics can create competitive advantages that are even stronger than the traditional moats we discussed earlier. Companies like Google, Facebook, and Amazon have built business models that would be incredibly difficult for competitors to replicate, even with unlimited capital. At the same time, technology has made it easier for individual investors to research companies, access financial information, and execute trades at low cost. You can read annual reports, listen to earnings calls, and analyze financial data from your smartphone, often for free. This democratization of information and access actually levels the playing field between individual investors and large institutions in some ways. The key is maintaining the discipline to use these tools wisely, rather than getting caught up in the noise and distraction that also comes with having so much information available. Just because you can check your portfolio every 5 minutes doesn't mean you should. Just because you can trade in and out of stocks with no commission doesn't mean frequent trading is a good strategy. Just because financial media provides 24-hour coverage of market movements doesn't mean that daily market news is relevant to your long-term investment success. I want to leave you with 3 practical steps you can take today to start implementing these principles in your own financial life. First, define your circle of competence. Make a list of industries, businesses, or types of companies that you understand well enough to evaluate their competitive positions and long-term prospects. This might include companies whose products you use regularly, industries related to your career, or sectors you've always been curious about and willing to research deeply. Don't worry if your initial circle feels small. Buffett himself has said that the size of your circle doesn't matter nearly as much as knowing where its boundaries are. It's much better to understand 5 industries really well than to have superficial knowledge about 50 different sectors. And remember, your circle of competence can expand over time as you gain experience and knowledge. Second, start practicing the mental models we've discussed by analyzing businesses you encounter in your daily life. When you go to Starbucks, think about what competitive advantages allow them to charge premium prices for coffee that you could make at home for a fraction of the cost. When you shop at Target or Walmart, consider what makes their business models successful and sustainable. When you use apps like Uber or Netflix, think about what barriers to entry protect these companies from competition. This kind of analysis doesn't cost anything, and it will help you develop the pattern recognition skills that are essential for successful long-term investing. You'll start to see the difference between businesses with strong moats and businesses that are vulnerable to competition. You'll begin to understand how different types of companies generate and sustain their profits over time. And third, if you're ready to start investing, begin with small amounts and focus on learning rather than trying to maximize returns immediately. Consider starting with just 1 or 2 individual stocks within your circle of competence rather than trying to build a diversified portfolio right away. This will force you to really understand the businesses you own and learn how to track their performance over time. And here's something crucial. Don't judge your success or failure based on daily or even monthly stock price movements. Instead, focus on whether the businesses you own are executing on their strategies, growing their customer bases, and strengthening their competitive positions. If you own shares of a company because you believe it will be more valuable 5 years from now, then you shouldn't be worried about what happens to the stock price next week. Remember, Warren Buffett didn't become one of the world's wealthiest people by finding some secret formula or by taking enormous risks. He became wealthy by consistently applying simple principles over many decades, by staying within his circle of competence, and by having the patience to let compound returns do their work. These same principles are available to all of us, regardless of how much money we're starting with or what our educational background might be. The beautiful thing about this approach is that it gets easier over time, not harder. As you gain experience evaluating businesses, you'll develop better intuition about which companies have sustainable competitive advantages and which ones don't. As you build a track record of patient, long-term investing, you'll gain confidence in your ability to ignore short-term market noise and focus on business fundamentals. And as compound returns begin working in your favor, you'll see firsthand why Buffett calls it the 8th wonder of the world.
But perhaps most importantly, this approach to investing aligns with building wealth in a way that feels sustainable and stress-free. Instead of constantly worrying about market movements or trying to time your trades perfectly, you can focus on identifying great businesses and then simply letting them do what great businesses do: create value for their customers and shareholders over time. When you check your portfolio, instead of seeing a bunch of ticker symbols that went up or down for mysterious reasons,
You'll see ownership stakes in businesses that you understand and believe in. You'll know whether Coca-Cola had a good quarter because you understand their business model and competitive position. You'll have opinions about whether Amazon's latest initiatives make strategic sense because you understand how their ecosystem of services works together. You'll be able to evaluate whether Apple's newest products are likely to drive long-term growth because you understand what makes their brand and ecosystem so compelling to customers. This transformation from trader to business owner is perhaps the most valuable outcome of adopting Buffett's approach. It changes your entire relationship with money and investing, from something stressful and speculative into something rational and empowering. You're no longer gambling on price movements or hoping that other investors will become more optimistic about your holdings. Instead, you're participating in the long-term wealth creation of some of the world's most successful businesses. And here's the thing that I find most exciting about this approach. It works regardless of what's happening in the broader economy or political environment. Great businesses with strong competitive advantages and competent management find ways to adapt and thrive during recessions, periods of inflation, changes in government policy, and technological disruption. They might face temporary challenges, and their stock prices might be volatile in the short term, but their fundamental ability to create value for customers and generate profits tends to persist across different economic cycles. This doesn't mean that every investment will be successful, or that you'll never experience losses. Even Buffett has made investment mistakes, and even the best businesses can face unexpected challenges that permanently impair their competitive positions. But by focusing on high-quality businesses, diversifying across several different companies and industries, and maintaining a long-term perspective, you can build a portfolio that's likely to compound wealth over time while being resilient enough to weather inevitable periods of market volatility. As we conclude our deep dive into Warren Buffett's investment principles, I want you to think about what kind of investor you want to be. Do you want to spend your time trying to predict short-term price movements, constantly checking financial news, and feeling anxious about daily market fluctuations? Or do you want to build a portfolio of businesses you understand and believe in? Check in on them periodically to make sure they're executing on their strategies, and spend the rest of your time focusing on other important areas of your life. The choice is entirely yours. But I hope that our exploration of Buffett's approach has shown you that there's an alternative to the constant stress and speculation that characterizes so much of today's investment culture. You can build wealth through patient, rational analysis of business fundamentals. You can participate in the long-term growth of the economy without trying to time market cycles or chase the latest hot investment trends. You can become a successful investor by applying principles that are simple to understand, even if they require discipline and patience to execute successfully. The Warren Buffett Way isn't about getting rich quickly or finding some magical system that guarantees profits. It's about developing the knowledge, temperament, and long-term perspective that allow you to participate in the wealth-creating power of great businesses over many years and decades. It's about understanding that building substantial wealth is a marathon, not a sprint, and that the most important factor in your long-term success isn't how smart you are or how much money you start with. It's whether you can maintain discipline and patience while compound returns work their magic. Whether you're a college student just starting to think about investing, someone in their 30s trying to build wealth for retirement, or someone approaching retirement who wants to make sure their savings will last. These principles can help you achieve your financial goals while sleeping well at night. And in a world where financial stress affects so many people's health and happiness, that might be the most valuable outcome of all. The opportunity is right in front of you. The principles have been tested and proven over decades. The tools and information you need are more accessible than they've ever been. The only question now is whether you're ready to start thinking like Warren Buffett and begin building wealth the right way, one great business at a time.